If you spend some time reading about investing online, you'll probably find yourself sucked into one of the biggest debates out there. It's dividend versus growth investing. Some people absolutely love the idea of dividend investing, and some people on the other side seem to think they're the biggest idiots ever, and growth is where it's at. So in today's video, I'm going to break down what dividends actually are, why some people love dividend investing, why some people hate it, what the tax implications are, and crucially, as an investor, is it what is going to bring you wealth growth over the long run? Because ultimately, having worked as a wealth manager and then in the financial education space, most people I speak to are concerned with that as the primary factor. Is their wealth growing, and is their money working as hard as it could be? Hi, welcome back. My name is Zoe and this is my channel, Words on Wealth. I'm a former wealth manager and I break down investing concepts and headlines to make you a more confident investor. So let's get straight into it. What actually is a dividend? Well, a dividend is something that is paid to shareholders when a company is doing relatively well. Normally, they look at their profits, decide that they're making sufficient levels of profit to be able to distribute to their shareholders, and on you go. You receive this nice little bit of money into your investing account. Now, dividend companies, or rather companies that pay a dividend, tend to be in a relatively similar category. They tend to be a little bit older, a bit more mature, they tend to have been around for a bit longer, usually more profitable, and often less volatile, because they need to have the money to be able to distribute it, and that fits all of those tick boxes. Often they're not hyper-growth stocks, and often they're concentrated in certain sectors. The sectors that we normally see companies where the highest dividends are paid are in the likes of utilities. I'm talking about your water bills, your energy bills. I'm talking about healthcare, as well as consumer staples and industrials as well. Now, there's no hard and fast rule. Dividends are not guaranteed and they will and can fluctuate as and when company profits change. So it's not something that you as a shareholder can totally rely upon. But for some companies, it is more usual than others. So now we've got what a dividend actually is, let's take a quick look at the history books for where the idea of dividend investing came from. It all originated with a bloke called Ben Graham, who wrote a pretty lengthy book on the idea of value investing. He truly believed that actually companies should pay a dividend, and if they didn't or couldn't pay a dividend, then they weren't really a successful company. Now, this is kind of now seen as an outdated view. A new train of thought started to emerge in the sort of late 60s, whereby actually it was argued that giving a dividend out is kind of like removing a slice of the pizza. Because a dividend shouldn't be seen as free money. It's not just something happy that arrives and means that your investment is doing really well. It does mean that to a certain extent, but what was argued in the 60s by some other economists was that actually by taking a dividend out, you're removing that money from the business, and that money could have otherwise been used in the business to reinvest in it and hopefully grow it a little bit more. And therefore, as a result, you as an investor probably won't see the same level of growth within that investment than you could have otherwise done previously. But it's not to be overlooked or kind of looked down on, because since 1926, the S&P 500, so that's the 500 biggest companies in the US, have seen that over 31% of their returns have come from dividends alone. And in 2025 alone, $78 was paid per share in dividends. It's not to be sniffed at. So whilst it is argued that potentially removing the dividend removes that money from the company and therefore a further growth opportunity, we do tend to also see that this is backed up by share price data, whereby actually on the ex-dividend date, so the day after the dividend is paid, the share price tends to fall by about the same amount that the dividend was paid out at. Crucially, what this dividend payment means is that investors then have the ability to make the decision themselves as to where they redirect that money. But There can be certain tax implications associated with receiving a dividend, and of course, it may mean that it impacts the future growth of that investment. In the post-COVID tech rush, where growth stocks have really dominated, this debate has become more pertinent than ever. And I also believe that online, we struggle to see the other side of the opinion more than ever, but that's a different story for a different time. Thankfully, there's some really helpful data that we can compare. If we take the S&P 500, so one of the world's most successful stock markets, the measure of the 500 biggest companies in the US, and we compare it with the S&P 500 Aristocrats. This is a really helpful group of companies that have successfully and continuously increased their dividend year on year to remain in this aristocrat group. Now, when we look at this chart, what we can see is that the aristocrats have done pretty well. In fact, in all the years pretty much running up to the point of COVID, they have outperformed the S&P 500. Now, when we saw COVID hit and then actually there was a pivot in the stock markets to a relatively heavy weighting towards quite a small minority of tech stocks that favoured growth, what we start to see is that those aristocrats begin to lose out. Now, what this doesn't show is, of course, what's happened previously, because the post-COVID boom isn't the only situation that we've ever seen in markets. If we zoom ourselves all the way back to the early noughties and the late 90s, where we saw what was known as the Dotcom bubble burst. There was a period of real excitement around the internet, and particularly the Nasdaq, the tech-heavy index in the US, became massively overvalued, and it plummeted and lost a considerable amount of value in a relatively short period of time. What this led to was many fearing actually what the future of these tech growth stocks were and pivoting their attention more towards the stable, the ones that generated a steady dividend and the ones that they knew they could rely upon in their portfolio, hence the dominance of the aristocrats in that time period. So what we can start to deduce is that if your goal is to grow the biggest possible portfolio over time, then having a strategy that is too heavily weighted towards dividends might not serve you in the long run, because we can see from these various charts that actually the outperformance does tend to come from those growth stocks rather than heavy lenience on the dividend stocks. But that's rarely the full picture. Because of course, most of us, particularly in the accumulation phase before we reach a point where we're withdrawing from our investments, do want to see a heavy growth in our portfolio. That's kind of normal and natural, right? But what that is overlooking is the potential for downturn. And what we have seen with the dot-com bubble, and potentially again if we see another bubble burst, is that in tougher times, generally those dividend aristocrats and those dividend paying companies are the ones that continue to yield well. So actually, there's a few factors that are really important when we're taking into account the wider view on dividend versus growth investing. The first is that total returns question, and this is taking everything into account. It's working out not just the dividend or the strength of the dividend, it's not just the growth or how much that's been, but it's all of it combined. And that is something that I do think can sometimes be lost in the nuance of this debate. The second main point is that of where you're at in your life stage, because actually if you're nearer to your goal, let's say it's retirement, then you'll probably be tending towards slightly lower risk, more stable stocks. And the reason for that is because of course you've not got the time to ride out potential highs and lows and volatile periods in more growth based assets, and rather you need the dependency of the income because you're going to start taking it sooner rather than later. What those dividend stocks can really do is not only generate an income for you to start withdrawing, but they can also generate an income that remains steady even during a downturn, preventing the negative compounding of an investing portfolio, but also helping to just keep things that little bit more stable as you get closer to whatever that goal is. And the other thing to think about is, of course, taxes. Now, taxes will be different depending on where you are in the world and what product it is that you're using to make your investments. If, for example, you're in the UK, the US, Australia, New Zealand, Canada, and you're using the various different tax advantage accounts that we have, then all this talk about taxes, you can throw it out of the window because it won't matter. But if you are investing through a simple brokerage account, paying taxes on dividends may well be, or may not be, more punitive than, for example, the growth that you see on high growth stocks. I can't possibly do an assessment of what that would look like for each and every country across the globe in just this video. I'd love to do it in another video, but it would be considerably lengthy and probably a little bit dry on the tax front. But you know, if people want it, then I shall deliver. However, the point behind this is to say it's always worth assessing, depending on where you are in the world and depending on what product you're using, as to what it looks like from a merits of tax positioning as well. Now, I've talked a lot about the theory there behind the ideas of dividend investing and growth investing and how the two have performed or not performed so well during good and bad times. But actually, in real life, most of us will be encountering dividends through the likes of funds. Usually, beginner and long-term investors are turning towards ETFs, index funds, and other passive forms of investing to keep things super simple and low cost as well. It also ensures that your investing is highly diversified. Now, when we look at different funds, often you'll see that when you're researching, there's two of every single one that come up. One will be the distributing share class, often abbreviated to DIS or INC, whilst another will be the accumulating share class, often abbreviated to ACC. And you'll see these at the end of the fund title. Now, what this tells you is whether you're going to receive the dividend into the cash part of your investing platform or whether you're going to actually just have it automatically reinvested back into the fund. Now, often the case is that even within the accumulating share class, you still have to pay the taxes on the dividends. It's just that you haven't received them. Normally, you request some sort of breakdown from the fund manager or indeed the platform that you're using, and you submit this to the relevant tax authorities to be able to pay whatever it is that you're due. I think for some investors, the psychological impact of having various different dividends arrive can be really motivational. It can be quite a nice kicker to add into the overall investing journey. But for others, actually, if you're at a point where you're just wanting a hands-off stage, or if you're wanting and getting closer to your goal where you're going to be withdrawing from your investments, all of these factors will influence what it is that you're wanting to choose when it comes to the different share classes, whether it's that distributing or whether it is that accumulating. The reality is that within the S&P 500, it's not just one or the other. At the moment, we are seeing a high concentration towards the growth-based tech stocks, but there is still a considerable amount of dividend stocks within there as well. Buying broader market portfolios, as I mentioned there, really helps with diversification and simplicity. Choosing the specific share class helps to filter through whether you receive the dividend or whether you simply see it automatically reinvested. There are merits to both, pros and cons to both, and a lot of it will come down to your personal factors. So call me an on the fencer, but I think there is arguments for and against both sides within this debate. I personally believe that actually a combination of the two is the most important factor to growing your wealth over the long run. And the time that you remain invested is way more important than what we see of the merits of individual techniques, or indeed than what we see of the various different factors of different techniques and strategies, and actually seeing that long-term compounding, how you consistently invested, whether you controlled costs and avoided panic selling when things became volatile, is way more important than picking a side. So I apologise if that was an answer that you came to that was slightly less exciting or perhaps polarising than you were expecting. But I'm genuinely curious to know, are you drawn to one or the other? Do let me know in the comments below. And as always, if you enjoyed this, make sure that you like and subscribe to Words on Wealth, and I'll see you in the next video.